Happy Tips and Tea Tuesday.
Happy Tips and Tea Tuesday. How are you?
I'm doing good. I woke up not dragging my feet this morning.
Hey, that's always
Last couple months. I'm trying to tell you, the last couple months has been like, woo, how did we get here? But I actually woke up with some energy this morning. Surprise,
let's
surprise.
go.
Yeah, I must say, shout out
Surprise,
to my business
surprise.
partners. hmm Shout out to my business partners, Carmen and Teresa. I was on a call with them yesterday, and they was talking about making sure you get in that bed early. So
Yes,
that's what I
ma'am.
did last night. I made sure I went to bed. I was in the bed by 10. I did not stay up to midnight, 1 in the morning. So big difference. Definitely big difference.
Yes, ma'am, it is. Glad you were able to get some rest last night and be ready for today.
hmm Definitely. How was your night?
My night was good. I didn't get to bed super early, but earlier than I normally do. So I was happy about that and got some things taken care of yesterday. So it was a good day.
That's good. Up, I spoke her up. Carmen is in the chat. Good morning, Queen. Thank you
Good
for jumping on
morning.
the live this morning.
Good morning. Good morning.
I'm gonna drop this here too.
I don't know what's
All right.
going on. I cannot see any comments, but it's okay.
Yeah, sometimes it glitches, our tips and tea morning shenanigans. Sometimes we see comments.
Right, right.
I
Sometimes
get
we do, sometimes we don't. It's okay. It's all good.
That's good. Well, I said let's get let's kick this off because we got a special guest coming on, and I love the topic that we're going to be diving into. So I
Yeah,
don't want us to miss out on anything because queens be having things to do, so
that we do.
we would love to stay on as long as we can, all day and just chat and talk. But we got to do things. We can't. It's not possible.
So true, so true. Well, good morning, good morning. Welcome in, everyone. Welcome to Tips and Tea Live. We are so glad that you're here with us this morning. Whether you're getting ready on your commute or just taking a moment for yourself, this is time to grow. Here on Tips and Tea, we talk about money, mindset, faith, building legacy. And today's conversation is definitely one that you don't want to miss. April was Financial Literacy Month, if you didn't know, and we are diving deep into a powerful topic, um, infinite banking,
Yes, definitely.
and how the oh,
Oh,
I'm
go
sorry.
ahead, Stephanie.
I was just gonna say, and how the wealthy use life insurance and they use
Yeah.
it to get ahead.
All right. Well, listen up, everybody. This is going to definitely shift how you see life insurance completely. And I just want to say good morning as well, queens and kings. Is if this is your first time tuning in, Again, welcome, like Ceateetra said. And if you're a regular, you already know. Let's go ahead and like, share, and tag someone who needs this conversation, especially if you've been thinking about, expanding your life insurance policies and was wondering how, the rich are utilizing themselves as their own banks, right?
Mhm.
So today we're talking about turning something most people see as an expense into an asset.
Yes, yes, yes. And we have a guest speaker for you guys this morning. So please help me to welcome this morning Mr. Dashaun Dunn. He is born and raised in Compton, California, and now calls Houston, Texas home. Began his unique, powerful perspective to the world of financial literacy. His background is rooted in mental health, having earned his clinical psychology degree from the University of Laverne and spending years counseling and supporting students at the university level. That deep commitment to helping people heal and grow didn't stop when he transitioned out of the mental health field in 2024. It just took on a new form. Now, after getting his own cash value life insurance policy in 2023, Dashaun had a realization that changed everything. He thought to himself that everyone needs to know about this. And that conviction led him to become a life insurance agent with a mission to teach families and individuals how to use dividend paying life insurance as their own personal banking system and as a pension plan. Outside of his work, Dashaun is a proud girl dad to a junior at Texas Southern University, and he serves on the board of the National Society of Black Engineers, where he continues to give back to his community through financial literacy and mental health advocacy. Please help me welcome our guest this morning, Mr. Dashaun Dunn.
There he is.
Good
Good morning.
morning.
Good morning. Welcome in.
Thanks for having me.
Oh, you
Yes,
are welcome. Thanks for joining us this morning.
yes, Deshaun, welcome. And, we're so excited to have you in this morning. And, we just want to ask you, what made you get into this aspect of insurance and infinite banking? What was your why behind it?
Yeah, that's a great question. For me, anything I do, like to this extent, I have to be passionate about it. And so for me, I was and still am passionate about mental health. I was a mental health therapist for some time. And, when I discovered this in 2023, I literally remember having that thought as I was getting my policy finalized, like, man, everyone should know about this. And I just kind of went on about, utilizing my own policy. And 2024 came about, and the latter portion of that year, I was transitioning out, and I was thinking about what is going to be my next step. And I was thinking about project management, thinking about tech sales. And then it hit me. I was like, more people need to know about what the policy that I have. So I was driving. I didn't even pull over to stop. I just called up the agent that got me started. I was like, how do I teach other people how to do this? And I got started in March of last year, and it's been a journey ever since. So
That is awesome. I love the fact that you learned about something and you were just so passionate about it that you wanted to share the information. Excuse me. For those hearing about this for the first time, what exactly is infinite banking?
yeah, infinite banking has it's got a ton of terms now, and it's a little bit diluted, but uh, it's very simple, really. And I kind of want to reference notes to make sure that people get a proper definition of it.
Hmm.
Um, Infinite bank is a strategy where you use dividend paying whole life insurance. There are other products that some people are unfortunately using, and I want to just clear the air. People are using index universal life insurance policies, IULs for short. We or I don't do those, and there has some risk and concerns around those. But to properly use it with the concept, it's a dividend paying whole life insurance policy. And you're using it as your own personal banking system in the same way that you're already doing this. And that's the crazy thing. You're already doing this. You're already banking with your checking and savings.
Right.
But the only issue is that someone else owns that. And so instead of using your money to be stored in a traditional bank, you're just simply transferring that money into a policy where you have control and you can borrow from that at will. And so the concept was created by Nelson Nash, and in his book, Becoming Your Own Banker, he outlines how people can utilize this system to basically, you're recapturing every dollar, the interest that you're used to paying to someone else. You're creating and taking control over a system that allows you to earn interest on every dollar that you earn and put into this policy. One more thing I'll add is one of Nelson's quotes. He mentions like the reality is that you either pay interest to someone else or you give up the ability to earn interest on your dollars. And if you think about it, I'm not sure how long you guys been working, but I've been working like since 16, 18 consistently. But I think about it, all the money that I've ever earned in my lifetime, how much of that money is still working for me? We were so used to just transferring it away. We got to buy a car, we got to pay a rent. That money has been transferred away from us permanently. With this vehicle, there's a way to first add one step. That's all we're really asking you to do. Add one step, put that money inside the policy, then borrow against it. And that way your money compounds and just never stops working for you. So.
Yeah, that makes sense. That's a good way to put it, especially if you're thinking about it. We've been taught, you need to get your money in assignment, right? If you don't, then your money's just going anywhere and everywhere. But money can also, even after you an assignment, sometimes it's depreciated, like that car you mentioned.
Exactly. Right? That's a great way to think about it. What this is it's a foundation. That's all you really think about it. It's not an investment, but it's a place, the best place on the earth to store your capital. Everyone should have the goal of storing capital. You're just saying, okay, where am I going to put it? If you put it here, not only will that compounding interest be earned uninterrupted, but then, as you just spoke to, Shantella, you get the chance to say, okay, I need to deploy this to my car note. I need to deploy this to an investment. I need to deploy this to pay off debt. You just want to store it here first, then deploy your dollars at will.
Oh, that makes sense. So why do you think wealthy individuals use insurance differently than like the average person?
That's a good question. So they understand that this is a vehicle, it's a tool, it is a great place to warehouse their wealth to make sure they're getting multiple uses of their dollars. They don't see it as a bill, it's not an expense. It's actually just gonna not only help them during their lifetime, but they're trying to transfer large sums of money to the next generation. And they want to teach the next generation a system of how to keep money in the family. There's another book that I want to reference, What Would the Rockefellers Do? By Garrett Gunderson. In this book, he talks about the major benefits of it, but he highlights there's two families in there, one the Rockefellers and the Vanderbilts. And he does a comparison. There were, the heads of those families, Rockefeller and Vanderbilt, they built large sums of wealth. Well, it turns out that the Rockefellers had a system to transfer their wealth to the next generation and educate them early on how to do it so that generations after the most wealthiest Rockefeller, the one who got it all started, would be able to transfer that wealth to the next generation, and they know how to manage money. Unfortunately, the Vanderbilts didn't have that. By the third generation, they were broke. They had millions, roughly almost I would say $1 billion in that time, in the early days. They just wasn't able to transfer that money to the next generation. And so wealthy people have discovered that, okay, this is a great place to put it, and there's really no better place. It's not like they're saying they're not investing in other things or doing X, Y, and Z. They just realize this is the best place to put their money, and it's not a bill. And for other individuals, you're going to be able to use this later in life, like your own personal pension plan. Imagine putting money in a policy over time, and when you're late 60s or 70s, you're able to just pull from it like a pension plan.
Wow. That's some very good information. Because a lot of people just don't know about that. A lot of people think, I have a life insurance policy through my job and I'm good there. I don't need anything else. But learning about this is really a game changer.
Yeah, and you mentioned I've come across certain individuals like, oh no, I'm good. I got it through my job. Okay, that's
Mhm.
great that you have it through your job. You own it. If you were to, for whatever reason, say I got a better job or a different job, or unfortunately get let go, now you're, let's say you stayed at that job. Let's say for random numbers, you were 30 when you started the job, and now you're 40, and now you don't have any life insurance because they let you go. Well, that's the thing. You want to get something that you own, whether you get
Hmm.
fired or not. Like, you want to own it. The older you get, the more the insurance is going to be. So some people are getting fired at age 50 or 60, right? That
Mhm.
life insurance does not go with you. So it is better to lock in when you're healthy and you're younger, and it's just much better to own your own personal life insurance.
I definitely can understand that. Can you explain to us how does the cash value life insurance actually grow money over time?
Yeah, great, great. So you want to look at life insurance as a contract with the life insurance company. They
Okay.
are contractually guaranteed to make your money grow. So what that means is, one of the means is that you cannot lose money inside of this policy.
Mhm.
It's a contract. It is ironclad. They have tons of money to make sure they're going to be able to pay you what they say they're going to pay, that death benefit. But they have their own ways of growing their money, and it's more, they're not trying to hit home runs like people are in the stock market when you're talking about 9, 12, 15% a year, which, another book. It's not all true what they say in there. You gotta read, but it's a lot of misconceptions about the stock market and how you're going to be able to earn. But back to the question, they're getting base hits. They're getting slow and steady returns, and they're very conservative companies to make sure that money is going to be growing. Whether that's in like investing in real estate, mortgages, and things of that sort, they keep your cash value growing in there. And so as you're contributing to the cash value, your money is continuously growing uninterrupted,
Mhm.
and then you're going to be able to see that cash value grow year after year after year. Top of that, while your money's doing what it needs to do, you, let me just back up a little bit. This is you and the life insurance company. It's like you're creating a partnership. It's like
Okay.
you're creating a business. If you think about it, you're creating a business that's going to need some time to grow. So because of this partnership, you now have access to, and again, going back to your pool of money, you now have access to the life insurance. You can call it general fund. So instead of withdrawing, taking money out of your pool of money, you can say, you know what, I'm just going to use the life insurance money. And this is the part where I said earlier, you're either paying interest to someone else or giving up the ability of your money to earn money. So in this situation, we're saying, oh, my money's going to keep earning money, but I'm going to pay and borrow money from the life insurance general fund. They have a ton of money for this, and I will be paying interest to them. So let's not get that confused. You're going to take a loan from their money while your money keeps growing. And just to wrap this up, and some people say, well, why would if I have money, why would I want to borrow someone else's money? Just for whole figure sake, if you put, let's say, $1,000 in a life insurance policy, and that $1,000 has the ability to earn $100, but if you had to pay interest $1 to the insurance company, is that a bad trade-off? No. So
Mm-mm.
that's the way you want to think about it. My money should be earning me more money. And if I got to pay $1 interest, and not, that's not real numbers, but it's kind of like that type of situation.
Okay. Thank you for the clarification on that.
Yes, and I just want to send a reminder to our audience that's out there. Good morning, everyone, and thank you for tuning in. For anyone who just joined the chat, we're speaking with Dashaun Dunn, and we're talking about during Financial Literacy Month here because we just want to be able to help with understanding once it comes to credit, comes to money. Dashaun is talking today about infinite banking, and really giving us a breakdown, on how the wealthy use life insurance to get ahead. So if you have any questions for Dashaun, you can definitely start dropping them in the chat as well. And Dashaun, just thank you for also, not only did you explain how the wealthy use it, but also you gave a breakdown of how we
Mhm.
can utilize it as well. So I also just want to ask you, is there a different strategy that you see that high income earners use versus everyday families? Is there a difference?
Yeah, well, I won't just say just the high income earners because they're actually, unfortunately, high income earners. Um, Before they discover this, they're just like everyone else, almost living paycheck to paycheck.
Mhm.
And so, and if you think about it, what I just said, I've come across certain clients who are in a ton of debt, right?
Mhm.
How did they get in debt? They have income. They're
Mhm.
probably contributing to some sort of 401k and IRA or Roth IRA. And what is happening there? They're being responsible, paying into their traditional retirement account for the future. But why is that not? I'm not going to say it's a bad thing to do, but what is happening there? What is a consequence? One of my mentors says there's no deals in life insurance. It's just uh, trade-offs, like you're compromising. And so I've been applying that to all sorts of things. Like there's no deals in like certain situations. It's just a compromise. So what's the compromise there? Well, using traditional retirement accounts, you're locking that money away for 20, 30, 40 years that you can't use it. If
Mhm.
you do use it, you're penalized. When you use it later, you're going to be taxed. And so when it comes to strategies with these high income earners, they have a certain portion of their money locked away. And then, oh, well, for whatever reason, I need to get a credit card and put a ton of money on the credit card. And now they're paying additional interest to these credit cards of debt. And that's the sneaky thing that people don't see. It's the volume of interest on your credit card, on your car payment, the mortgages on the homes. That's a whole another level of overpaying and interest. And so the volume of interest on all these things that we're paying, it leads people to feel like I have all this money, but I have nothing to show for it. But when a person, the high income earner, or even the average person, discovers the infinite banking concept and understands how to get their money working for them, everything can switch. I have clients be in debt. One of my clients, younger guy, he has 63K in debt, scheduled to pay that off in like 8 to 10 plus years. Uh, the same amount of income, we're going to be helping him pay that off in less than 3 years. So again, all he did was switch to where his money was working. And I did mention earlier, this comes with dividends. And so, as far as strategy, when a person sees it for themselves and see their numbers, and especially a high income earner say, "Oh, well, all this money is just leaving me, is never coming back to me," they make that something clicks for them. They say, "Yes, I have enough income where I can contribute to this on a monthly and yearly basis, and I see how this is going to work for me in the long run."
That's good. It comes back to, you do have to come up with a plan for this, because I don't know, I think some people also think it might be a get rich quick strategy.
Mhm. Yes, always.
Yeah, you know what? I think
The infinite banking, they're their own banks. They set up their trust. I
mhm.
got this. I don't have to fix my credit. They don't even have a regular bank account yet, and they're just like, I can do this, and I'm gonna make money real, real fast.
Yeah, yeah. You know what? Unfortunately, we live in, the term is called a microwave society where we want things done
Yes.
in 15 to 30 seconds. And, that would be great if it actually did work that way. But just like credit repair, it's going to, like, you spend
Take time.
years jacking up your credit. It's going to take a few months or a year to kind of get back to where you need to be, right?
Yes,
It's
definitely.
the same thing with this, and this actually goes hand in hand. Like, I actually help people, um, you know, in a more effective way, pay off their debt with something that they're going to own.
Mhm.
And when you're being responsible, paying off the debt with the credit cards, or if you're just kind of like trying to get some of that stuff off your record, what is happening is when you're just the traditional way, you pay down that debt down to zero. Is That's just it. When you've transferred money away from you permanently, it's going to go work for someone else.
Mm-hmm.
The debt is gone. That's good. What we're saying here is first add that one step, put it in the policy, then pay down the debt. Your money's still working for you, and you get to pay down your debt. And so, kind of rambling, I forget where we are originally at, but the idea is to make sure that you're getting multiple uses of your dollars, and you can do that. So you can take care of your, improve your credit, and that's the point I was trying to get to. You want to think long range. It's not a 30-day strategy, a 60-day strategy. You want to make sure you're thinking not only for the next 20, 30, 40 years of your life, but 2, 3, 4 generations ahead.
Yes, definitely. Thinking ahead is always a game changer.
Yeah. Yeah.
So, for someone out there that really doesn't know too much about this, what is the difference in borrowing from a bank and then borrowing from this type of life insurance policy?
Great question. So, say if your credit is decent enough, right,
Hmm.
and you're able to prove some sort of income, you're going to have to go fill out an application. They're going to
Right.
run your credit. They're going to tell you how much you can qualify for. You got to go through these extra steps. And so, what's happening there is you're at the mercy of the bank. When you do get that loan, they're going to set the terms of when you're paying that back. What if you got to go take an emergency family trip out of state to attend a funeral, or you wanted to do X, Y, and Z? You can't really call up the bank and say, "Well, I got this situation. I'm gonna pay y'all in 2 months."
Right.
I don't think it works that way. They want their money no matter what's going on in your life. So they have all the control. They set the terms. You're at the mercy of them. Well, if you, again, change the way you're thinking about banking and you become your own banker, you build up the capital in your policy,
Hmm.
and you don't need no permission. You can say, you know what, I need to take a loan for $3,000. You take care of whatever that expense is, and then, okay, I need a little bit of breathing room to get this loan paid down. Well, you technically, I want to say technically, you do not have to pay it back, but it is very wise to pay it back, because once you pay it back, you replenish the amount of money that you're going to be able to um, utilize the next time you need it. Why keep that money in someone else's bank just sitting there? It's not earning you anything, and that's another thing to know. Technically, when we put our money in the bank, it legally becomes theirs temporarily. What
Hmm.
they do, they loan it out to other people, and other people are paying interest on your money that the bank loaned out to them. And then the banks, they make a ton of money. I'm talking about 300, 400% on money, and they're paying you pennies.
Yes.
All we're saying is take advantage of the ability for your money to earn uninterrupted compounding interest. Allow yourself to get access to a pool of money that the life insurance company has. Yes, you are paying interest, but the amount of money and dividends that you're going to be earning year after year after year, once you see the illustrations, you'll be blown away and be surprised how this thing works.
Mm, that sounds amazing.
Yes. I will say, just kind of be careful, everyone, with borrowing too much against your policy, because if it comes too overloaded, it can lapse as well.
Mm,
Things that people also don't talk about. So thank you for sharing that, Dashaun. It's some really great information, and we are saying, this is a great tool to help build wealth for generations to come. But you also still need to fix the credit. You can start with a high yield savings account, and this is foundational pieces that lead to something like this. If you on your last dollar, you might not be here yet, what
Right.
Deshaun is talking about, but you can get there by building up those healthy habits and being consistent. Even
Yeah.
because this policy, consistency is one of the key things, right? when it comes to funding this policy and growing it over time.
You bring up a great point. I've met with people and they said like, this seems too good to be true. Like, what's the catch? Like, what's going on? Like, what's for real? Keep it real. What's really going on? Well, I tell them, well, there is a catch.
Mm-hmm.
All that I've said is true about this, but the catch is you got to look in the mirror, and that's the catch. Because your human behavior, and I got to bring up this book again, Nelson Nash, Becoming Your
Those
Own Banker.
books.
Yeah.
He talked about the human factor, where think about a 16-year-old getting into a Lamborghini his first time driving. The
No doubt.
A Lamborghini car is a great car, right? It goes really fast, really well designed. But if you put someone who doesn't have the proper discipline in it, they can crash it. They can ruin it.
Mm-hmm.
Same thing with this vehicle. It has so many perks to it, but if you put someone who's not disciplined, who's not ready to, build that credit right, pay down those debts, they're spending more than what they're bringing in every month, you can ruin this. You can lapse a policy. And that's why we want to design it that fits your needs. Mm-hmm. And you don't want to just get in this thing saying, oh, well, I ain't got to pay it back. I'm cool. I'm the boss. I'm the bank. Well, yeah, if you want to be a responsible boss and banker and make sure you're paying yourself back on, responsible terms, and don't just think that, oh, just because I don't have to pay myself back, it will catch up to you. Trust me.
I can definitely understand that. It definitely starts with us. I mean, you can't get a policy like this and just think, oh, I'm just going to borrow and not pay it back or just let it go. You do have to be responsible. And what is like a good amount that you would say that for people to start investing in the insurance policy? What would be a good amount to start with?
Good question. I'm going to start here by saying this. So the best time to get a policy done on you is between being 15 days old.
15 days.
And I say that because you can't get it before that because it takes a couple of weeks for your Social Security card to come. And so I would say when you're born, but it literally takes 15 days so you can actually apply for it. Your parents can. And then the second best time is now, today. Like, do it today. But in regards to how much to contribute, one, get started. If that's only a couple $100s a month that you can put away, that's fine. It kind of depends on where you're at. Like, if we're talking about a 22-year-old, 200, or like I like to add a zero behind their age. Just like that gives enough time for your money to grow. So if you're 22, $220. If you're 30, $300. But if you can't do that right now, start somewhere. Other individuals, and again, like IRAs where they have a 7K max and there's a max that you can put into it. There is no max. It just kind of depends on where your income is at. And so when I work with people, I get a free debt report. If you're starting with some debt, you'll fill out some intake form. I'm going to show you how fast you can pay off your debt with the same money that you're spending now. If you're making extra payments on your debt, that's even better. All we're going to be doing is transferring that money into the policy first, then using it to eliminate the debt. And so it kind of just depends on where you're at. It's not a cookie cutter approach, but if you're thinking long range, one of Nelson Nash's principles from that book, he says, don't be afraid to capitalize. And that's what I see from certain people. Say, oh, well, how much can I put just $100 a month? Well, yeah, you can. But don't expect this policy to be taking care of you by the time you hit, 65, 70. So before you put into it, before you get out of it. And I'm sure we have a moment. I think this would be a great time to go through this box exercise that I mentioned.
Okay.
So I heard this yesterday, actually, this metaphor analogy that I came across of one of the infinite banking practitioners that I came across he talked about how he was explaining this to his young daughter. And he said, what if you had this magic box that where you put $1 into this box in the first few years? Let's say the first year you put $1 in, you can use about 66 cents of this box or in the box. And then the second year you put in another dollar and you can use about 75%. Third year, maybe like 88% or percent cents. I keep making sense, but it's the same thing. 88 cents. And year four, you could probably use about like 96 cents of that dollar. In year five, you put $1 in and you can use $1.20. Now at that point, it's become capitalized, and this magic box is producing more money and is going to continue doing so for the long run. What about when year 20 comes? You still put in that same dollar, but now you can use $5. That's right. It's gaining more and more and more. And as he was explaining to his daughter, he asked, like, well, if that was the case, how much money would you want to put in there? And she said, well, I would want to put all my money in there. Like it just like produces more and more and more. Like, yes, that's right. Then he asked, well, how long would you want to do that? And she's like, well, why stop? Do it forever. I'm going to do it forever. That's right. She's already thinking long range, like a young child. She got it. And so the next thing was she asked, well, when can I open the box? And then he told her, well, the thing is, you don't want to open the box. You have access to the life insurance company, like I explained earlier, where you could just basically go to the life insurance company and says, I have this cash value here, this box that is have all this money. I want to use your money. So the life insurance money company gives you access to your money, and they're using this as collateral. And so essentially, he ended up telling her, you're never going to open this box, but your kids will open this box. When you pass away, your kids will receive all of the money that's in this box, and you would have wanted your kids to start their own magic boxes long before they get to open yours, so that all the money in this box can be transferred to their magic box. And so I just thought that was a really unique way of, explaining it to a child and getting people to see that, one, you want to think long range, and the money just keeps compounding and growing, and paying a small interest amount to a life insurance company isn't a bad thing, because that box of yours is growing so much more money than what you're going to be paying into the life insurance company.
Yes, I like that. That's a legacy planning.
Yes.
Just thinking the opposite of, oh, life insurance is, talking about death, and, we have a fear of that. Even mentioning it, we think it's bad luck, but, you have to address it. You have to talk about it. How else are you going to build that generational wealth? And we always say legacy, 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 but, it starts somewhere, right?
Yes, absolutely.
So we have comments in the chat here. We have Teresa. She did comment. However, if you don't pay it back, it comes out of the death benefit. I think this one she was talking about the loan that you take out.
Exactly. So let's just say, I don't know, like you have a $200,000 cash value, and for whatever reason you needed, you got wise to say, instead of paying the dealership money, extra interest, I'm going to borrow from my own policy, get my own bank. I'm going to take 30K out, 50K, whatever the case. You buy the car and you're paying yourself back. Let me say this properly. You're paying the life insurance company back. You are a partner in it. You will benefit through the dividends, but you don't get to pay all of that back and something happens to you. Well, of 200K death benefit, 50K was out. What happens is the the beneficiary will get paid 150,000. You're right. It's collateralized. So that's why technically say you don't have to pay it back, but it is wise to do so, because the beneficiary is just going to get whatever you didn't pay back.
That makes sense.
Thank you for breaking it down, and thank you for Teresa Smith for dropping that in the chat as well. It's definitely good to know. So you have to go back, everyone, and remember, what was your why originally for starting this, right?
Mm-hmm.
Were you doing this for your kids, or was this a quick get rich quick strategy, which we already addressed?
Yeah.
This is not that.
Absolutely.
Right.
I do want to say there's certain people who don't have kids.
Mm-hmm.
Maybe they don't even have nieces and nephews. Well, the thing is, again, we're talking about becoming your own banker. I was about to bring up the book. I've seen the book multiple times already. Yeah. But you're taking control over your money. Whether you have kids, nieces and nephews, maybe you just want to donate it to a charity.
Mm-hmm.
That's talking about the death benefit. The death benefit is very important, especially we're talking about legacy planning. But we're talking about you controlling your own money, not just letting the bank get rich off of you and making tons of money off your money. We want your money working for you. You want to be able to use this. Before we talk about the death benefit, first we're talking about you taking advantage of your money, making more money for you. You may get sick. You're going to need another car. You're going to be hopefully aging into your 60s or 70s. And if you haven't been paying attention, there's a retirement crisis going on. People in their 60s, 70s, and 80s having to go back to work because they don't have enough money. So, using this as your own personal pension plan, if you do this right over the next 20, 30, 40 years, you will be more comfortable than the current retirement class that are having to go back to work. I'm gonna bring
Yes.
up one more book again. Guaranteed income. Like it's so much information out here that it teaches you how to do this. But the unfortunate thing, people like again, these books aren't exciting. I'm excited about it, reading and learning about it. They're boring a little bit because it's not talking about these home runs or whatever. But I've been doing the research. I've been looking into it so that I know most people don't read these types of things, and it's not a knock on people, but when I try to explain it to them, it's kind of just like goes over their head. So that's why I love this box metaphor that kind of can help people get it. But the information is out there. You have to be seeking it. And I see a comment saying, what kind of insurance is that? It's dividend paying, participating whole life insurance. And again, to be clear, I know there's agents that are selling index universal life, but it's not IULs, and there's a certain reason for that. And the only thing I'll add to that, because I am encouraging you not to, as you age with these IULs, it comes with a renewable term. And term insurance is relatively cheap when you're younger, but as you age and you get a new renewable term, when you're 65, 70, those premiums are going to be higher. And if the stock market or whatever the index that it's tied to isn't doing well that year, it's going to eat at the cash value. And if the cash value has been eaten into too much, who's going to be stuck with that bill? You are. So at the time you need the cash value the most, and when you're going to pass away, your family needs that money the most, the policy will lapse.
Mm.
Yes, that's a good question. Thank you, Kiera, for asking that question. We have one more comment from Teresa Smith. You can take a loan off of most policies except term holds no cash value.
Yep, absolutely. The term policies, again, whether you're talking 10, 20, 30-year terms, those don't build cash value.
Yes. Well, thank you. Thank you. What I do want to kind of jump in and do like a quick lightning round because we're coming up towards the end of tips and tea, but we want to keep it a little fun because I know we've been talking about insurance and infinite banking. We've been, I was scolding people a little bit. Just a little bit. I wasn't too bad this morning, right? Yeah.
No, not at all.
But we did want to ask you, Dashaun, we want to switch it up. What's one money habit, you wish you would have learned earlier?
I would say this concept. I can't, and I know that may sound, cliche or whatever, but I can't tell you how many times I've said to myself, I wish I knew about this when I was 20. I've always been a great saver. I've always been good about saving my money. And one quick story, I remember I had a 2005 Nissan Maxima, and I had around 11K worth on my note, and I had around 11K in savings. What did I do? I took that and paid off my car note early. I kicked myself in the butt. Like, man, like I wish I knew about this. I would have definitely put it in there instead of like just like I've been always responsible with money. I just wish I knew about this much earlier.
I can definitely understand that. This Infinite banking is a game changer. I'm
Yeah,
definitely interested in looking into a policy myself.
yeah, we could definitely talk.
Yeah, we were all saying, even last week we were talking about this too. I was like, I wish I would have my first job invested in the 401k a lot earlier than I did because I waited until I was in my later 20s
Mm.
to, use that benefit of the employer, matching me. It's like that was free money that I was just not, partaking in. So, and I know teachers like, I wish I would have gotten to my credit sooner, you know,
Yes.
focusing on that. So that's good. That's good. Well, coffee or tea, Deshaun?
You know what? Even though I did work for Starbucks for some years and I was a little bit of a coffee master, I didn't drink a lot of coffee. I've always had energy. I'm a more of a tea person this around this age.
Hey, you fit
Hey.
right in. Tips and tea in the building.
Yes, yes, yes. Let's go. Nothing wrong with that. Nothing wrong with tea.
That's
Um,
it.
and Deshaun, what does financial freedom look like to you personally?
Financial freedom looks like to me just being able to do the things that you not only want to do, but you need to do without worrying about how it's going to impact um, your bank account, and even your legacy beyond that. It just gives you, it's a weight off your shoulder to be able to say, I know I have my things in place, not only for
Mhm.
myself, but the ones that are coming behind me. And it just kind
Right.
of lets you plan for yourself, be able to spend time with the people who you want, take trips, and do the fun things to have a well rounded life.
Yes, sir. I know that's right. A well-rounded life. That is
Mhm.
the goal.
Yeah.
Yes, definitely. Well, I just want to say thank you again. This was a really great conversation. I'm gonna give our audience a little bit more time. I'm just gonna remind them real quick. If you have any questions for Deshaun, definitely feel free to drop it in the chat. I'll also drop his digital business card as well. That way, if you want to contact Deshaun directly, you have any more questions about insurance and whatnot, he's definitely a great resource to assist you as well.
Mhm.
Also, just want to say, because it's Financial Literacy Month, everyone, we want to help you take action and not just listen. We talk a lot about the different things, but if you do need some guidance and some help, if there is some credit issues that you have going on, or you're just trying to figure out next steps for your business, we do offer free consultation calls, right? We can help you come up with a roadmap of what it looks like to aim towards those goals that you've been talking about for a while. We do have a special promo, so if there is some issues going on with your credit, we have a $50 off that we're offering in honor of Deshaun being here. Because we
Yeah.
want to start with the foundational pieces, where it's a done for you credit repair program, and we're also helping people with getting to the funding as well. So if you have some questions about personal business funding, we are here to help. So we'll definitely help you with those next steps. But Deshaun, we just want to say thank you again for joining us
Yes.
today and pouring into our audience. This was definitely very powerful and very informative. There's some things that you
Yes.
talked about. I wrote down some of those book titles.
Yes, honey. Me too. Me too.
Checking those out.
Last thing I would say on these books, this is foundational to understanding how this concept works.
Hmm.
This one, what would the Rockefellers do? It's more of a entertaining read. So some clients, I recommend them starting here first,
Mhm.
but then coming back to the Becoming Your Own Banker book. It's foundational to understand how to maximize this particular type of policy. So what would the Rockefellers do? And then Becoming Your Own Banker.
That's good. We love that. And the fact that you want
Yes.
to educate, not just because what we're doing, none of us are just trying to sell people, right? We're in this because we want to make sure we're building up our communities and we have a heart for service. So the fact that you want to educate and empower your community, we just want to say thank you for that as well.
Yeah, thank you for acknowledging that. And I know you guys are like in that same boat. Like yes, there is a product to buy here, but I'm a terrible salesman. I don't want to sell anything to anyone. I want to educate our people and
Hmm.
share this important thing. It's credit
Mhm.
repair. It's financial literacy, the whole gamut. Like people want to share these things, but unfortunately, some people are too scared to be sold, and they miss out on very important information.
Yes.
That is so true. Well, I definitely appreciate you coming on this morning and sharing this information. because there's not a lot of people that know about this. And this really can be a game changer. And even if it doesn't change it for you, it can change it for your child or your grandchildren, you know? So this is
Mhm.
awesome information. And we definitely appreciate you coming on and sharing it with our audience.
Well, I appreciate you guys for having me. It's been a great time. I love the platform that you guys are hosting and creating, and the space that you guys are creating for people to come and learn about important topics. I tuned into the last one you guys had, and it's not just about, it seems like, financial literacy all the time. You're talking about things that are important for people to learn about, and I love the platform that you guys are building.
Yes, sir. Thank you. Thank you.
All right, and just double checking our
See if there's
YouTube.
any more questions.
Yeah, just double checking. But sometimes there's a slight delay, so it doesn't pop up on the screen right away.
Yeah, as you're checking that, again, it's a simple process. You meet with me. Step one is meet with me. I show you exactly how this works. Step
Mhm.
two, you get your numbers done. You see how this would impact you, and then if you like what you see and understand it, then step three is putting in an application to see if you get qualified. And the thing about this, you have to qualify for this, and so better sooner rather than later.
Mm. Okay, no question. You said we have to qualify. What are some of the qualifications that you have to meet? If you don't mind
Great,
sharing that with us.
great question. So when it comes to life insurance, they're like your age, your height and weight, your health, um, like your health history, all those things matter. And so if you are healthy enough, you can qualify to have your own policy insured for yourself. Now, other scenarios where, let's say you've had cancer recently, you had a stroke, whatever the case, life insurance company are less likely to want to insure you. That doesn't mean you can't own a policy. If you have what is called an insurable interest, you have a child, you have a husband or a wife, or you have a brother or sister that will be allowing you to kind of have that insured. There's ways to get around it where you can still own a policy so you can take advantage of taking over the banking function. That's what this is all about. It's not just about the death benefit. We're talking
Mhm.
about taking control over your money and having a place to store it. There's other ways, but those major factors is even gender. I forgot to say gender. Women, females, they're rated better than males because they live longer than males. So
Mm.
those all those factors are coming into place when you're attempting to qualify for a policy.
Okay. Well, thank you for that breakdown. Definitely appreciate it. Did you have anything else you wanted to say, Shantella, before we close out?
Nope. The Queen's got things to do, and so does our king here, Mr. Dashaun Dunn. So we got to go, everybody.
She said we got to go. Well, we definitely appreciate everyone tuning in today. If you take nothing else away from this today, remember that life insurance is not just protection, it can actually be a strategy for building wealth. And the key is education and being intentional with it, using it intentionally.
Yes,
So
thank
make
you.
sure you definitely stay connected with us, like, follow, and share. If you know someone that needs this information, please tag them. And don't forget to follow us on YouTube at Tips and Tea Live.
All right, everybody. Thank you again. See you next week.
All right, next Tuesday. Have a blessed week.